Welcome back, guys, to another episode of 5 Minute DD. Today, I'm really pumped. I threw this together really quickly because the ticker we're talking about today, SACH, is one that I've been watching for like 2 years now. And I thought I already did a video on it, but I checked my files and I haven't. And so I wanted to talk about it. Now, I'll start by saying this 5 Minute DD, I'm not biased by any means. I own SACH. I do own it, but I understand that there's a lot of risk with this stock, and that comes with this high of a dividend yield. Now, looking into it deeper, I did find a lot of things that I liked, but I also found some troubling things, mostly with the management, one portion with the management that I'll talk about, and the long-term chart. So we're going to jump right into this. I hope you guys enjoyed the video. 5 Minute DD is where I do some research. I let you guys know everything I want to know about a stock before I bought it. Some of this stuff I should have known before I bought SACH, but I'm still holding it as of now. So we'll jump right into the pros. It has a 13.9% dividend yield, quite a phenomenal yield in any standard. 14% is arguably not even sustainable, but there's reasons why the yield has gotten so high. And part of that is because it is so beaten down. Now, if we look at the 1-year chart, we can see it is down 36% just this past year. Normally, that would rule me out from purchasing a stock, but there are a number of reasons with what happened with SACH, as well as the overall market sentiment that caused this drop. We can see it was trading in the 465 range pre-pandemic, dropped really low in the pandemic, and then ran like crazy and sold off. So part of this crazy drop in the price is due to how the market was just so fluffed up after the pandemic. Everybody was buying things because it was so low, and it just basically wasn't sustainable at all. And so that's why SACH is a little bit on the riskier side. Now, they have a $448.5 million loan portfolio. That's what they do. They are a type of REIT, but they don't pay monthly dividends, which is interesting. But they should still be paying out that 90% that REITs are required to by law to pay out. So that is very interesting. When I looked into the company, so I pulled up their investor presentation, tons of information here, guys. If you are consider buying this, go look at this investor presentation. They have a bunch of stuff in here that I was really happy to find out about, and some things they hit a little bit, but I also found, and I will talk about those. So go check this out. I will link this in the description below in this video if you guys are interested. Another great point about SACH is that they are expanding quite a bit. They went public in 2017. So a pretty rough time since then. The market itself, even if you don't include the pandemic drop, it was still down 11%. Nothing terrible, but still below the IPO price. And now it's well below the IPO price by about 26%. Now, with them expanding, they've been growing for a long time, growing all their investors, growing what they're doing. And so now they're expanding to 11 other states. This is all from their presentation, including Florida and Texas. Now, why did I include Texas and Florida specifically? Because those are large states. And what they're doing when they do these secured loans, I like the more tech-heavy, larger states rather than some smaller states. I think that Texas and Florida could be a much better revenue growth for the company than a smaller state, or a state that's maybe more rural. If you're talking like Iowa or Ohio, nothing against those states. I just like bigger tech states, and Texas and Florida are still behind, California and New York and a couple others, but they're getting there. So I do like that about SACH. And then targeting stable and experienced sponsors that help them grow their overall loan portfolio, which is really important. That kind of goes without saying. You would hope that they would say that they would be doing this, but I'm glad that they did state it in their presentation. I forget where exactly they put it, but after reading this thing, I can't remember where everything is. But I do like that they put that in there, and I think it's an important point in all businesses. Now, this is probably the biggest pro for this company, is that Q3, which is the last quarter they have done earnings on. That Q4 should be coming out pretty soon here. But Q3 2022 revenue increased 58.9%, which is phenomenal on its own. But what's absolutely insane as well is that 89.5% increase that they had with their interest income. Now, I'm not sure if this is because they're doing floating rate loans. They didn't specify why their increase in interest has grown so exponentially. It could be because now they're getting a lot higher interest rates, or they're just getting more loans and they're focusing on more loan types with higher yields, which is why they're getting more increase in their interest. Overall, a good sign, in my opinion, for the company. Now, this is pulled directly from their presentation. Founded in 2009, private partnership grew to 175 partners. This is where I was talking about their growth. 30 million in partners, capital up to the IPO in 2017. So they have a history. They've been working on this company for a long time and just took it public in 2017. Highly scalable business model. As a REIT, distributes 90% of the company's taxable income to shareholders as quarterly dividends. Awesome. Love that. They talk about how disciplined the underwriting is. All loans secured are first lien mortgages with conservative target 70% loan to value ratio. Now, I don't know if you guys know the difference between first lien and second lien mortgages. From my understanding, first lien is just better. I couldn't dive into the details and tell you exactly why. I don't know that much about mortgages, but I know that first lien debt, typically, I believe it means that they are paid out before the other debts. So let's say that they default on a loan. SACH is going to get more money from whoever defaulted on the loan than someone would if they had a second lien mortgage. So that is an important part that only comes in if they start having worse people getting loans from them. That was a really poor way of saying that. But basically, it's only in a bad market if a lot of loans start to default. That's when that will be important. They haven't been doing that, so it's not necessarily as important right now, but it is a good safety net in my opinion. And they have an industry low foreclosure rate and default rate, which kind of negates what I just said, that it is still good that they have that, but it's almost unnecessary according to them at least. So only time will tell, but let's look at the cons. So the sporadic dividend, I'm going to pull up the dividend from NASDAQ.com. Now, the crazy thing, and one of the most frustrating things you can get with a dividend paying stock is a dividend decrease, a dividend cut. It is a very bad sign. Typically, it's a sign of poor management. And with SACH, I do like their management, but this was a big mistake that they made, and it definitely has accounted for some of this drop in the overall price as well as the overall market. So if we jump back, they started in 2017. They paid 3 dividends out that year, paid 6 out in 2018, 5 out in 2018. So some special dividends, which is great. Jumped one up to 17 cents, a pretty remarkable jump from their 12% typical. So their special dividend looks like they had a 17% special dividend, which is great. And another 10-cent special dividend. 2019 was their bad year where they actually didn't pay a dividend in their last month in December, which is definitely a negative, but that was in 2019. They're still growing. The market in that time wasn't awful, but pandemic-wise, it was going to crash pretty hard. No one really knew. But if we look at 2019 on the chart, they were doing pretty well. I'm guessing that this dividend cut right here is what caused that, or the lack of a dividend. And then jumping into today, so they have been increasing their dividend. They had it at 12 cents for a while, really good dividend growth. They jumped it to 14 cents. I remember when they did this and everyone was freaking out about SACH. People were loving it. I loved it too. And then they announced that they overshot and they had to cut the dividend 1 cent down to 13. So basically, they were just overly ambitious. Management should have looked more into that, realized it wasn't sustainable. Now, they didn't necessarily know what the 2022 market would bring, and so I understand, they were hopeful because the market was doing insane, and so they probably speculated that it would continue, and that was the mistake. So they did cut their dividend, but in the end, it's a better reason to cut it. I'm glad that they cut it because it showed that they weren't going to just carry out an unsustainable dividend, and they actually proved, hey, we made a mistake. We're going to be honest. We know it's going to hurt, some of the price appreciation and whatnot, and some trust in the company. They fixed it, and now we'll see if they continue to grow their dividend like I hope they do. Long-term chart, terrible, like we talked about, but it's been a rough couple of years to start trading publicly. And low market cap, really low market cap. This is a con. It makes it a little bit sketchier when it comes to the company itself, in my opinion. Now, it is pretty remarkable that they have a $450 million loan portfolio and the market cap is only $152 million. That doesn't mean that they have $450 million in cash, of course, and stuff like that, which is why the market cap is probably still pretty low. But it also proves that there is an insane ability for growth for this company, which I agree with. I think SACH has some insane growth potential. That's why I am a fan, and that's where the bias does come in, because I after doing my own research on the company, you see it on Twitter and on TikTok and stuff like that, but after doing my own research, I do like the company, and I do think long-term that because of how just kind of honest the management has been, even with their mistakes, they're definitely not perfect. They have talked about it, but I like that they were honest with it, that they cut back. They didn't over fluff the company in an attempt to just maintain that too high of a dividend yield and then have to cut it by half. They fixed their mistake. We'll see how they do now. Still very speculative. I hope you guys like this video. I'm going to wrap it up. These videos are quickly becoming 10-minute DD because there's just so much I want to talk about with these stocks. And there's so many important factors that I think people should know before they buy in. Hopefully the 10-minute videos are all right with you guys, but I'm going to keep the title of 5-minute DD and see if I can keep it lower. If you guys found this content useful, if you could like it, that helps me out a ton. And also, if you guys don't mind subscribing, if you like this content, I put out about 4 videos a week, and I've just started doing more shorts on random things that I find which I like. And then comment a stock that you'd like to see a video on for 5-minute DD. I've already done some viewer requested videos. I like to do it. It gives me more experience doing my own research on stocks I don't know about, as well as exposes me to some new stocks that maybe I would want to buy later on, depending on how the 5-minute DD video goes. So that was a whole mouthful. I hope you guys found this content enjoyable. Let me know. I always love criticism down in the comments, even if it is negative. That helps me grow. So I appreciate you guys for staying this long, and I hope you have a great rest of your day.